What I do know is that there is a strong cultural predisposition to buying gold among ethnic Chinese. I've done business with ethnic Chinese for 20 years, at least. In China, not just in North America. And there's a strong interest in gold. It wasn't that long ago that Chinese were prohibited from owning physical gold in certain terms, with certain exceptions. What you see now is that the government of the People's Republic of China is actively encouraging savings in gold. And I think that there's a lot of appetite in the citizenry for increasing their gold holdings. Private savings are increasing rapidly in China, and the Chinese people in general have a predisposition to save as opposed to spend. And I think that there's a lot of concern in China. I can tell you this anecdotally from Chinese people that I correspond with, about future economic stability in China. And so there is a nervousness among many Chinese about investing in traditional savings products. At the risk of being accused of being racist, the Chinese people that I know are very much gamblers and very much speculators.
With China's appetite for gold savings surging, Rick Rule explains why this trend is set to explode the gold price. Recent data shows that private savings in China are increasing rapidly, driven by widespread concerns over future economic stability. The People's Republic of China is now actively encouraging its citizens to invest in gold, marking a significant shift from previous restrictions. Rule emphasizes the strong cultural predisposition among ethnic Chinese to buy gold, predicting a major impact on the global gold market. Central banks have been the biggest buyers of gold, driven by geopolitical tensions and the weaponization of the US dollar. The fact that gold prices have risen while traditional retail investors in Western Europe and North America have been sellers indicates a significant shift in who is driving the market. As Chinese citizens increase their gold holdings, this could lead to a surge in demand and consequently a spike in gold prices. Rick Rule also notes that the delayed understanding of inflation's impact on personal finances will lead to a surge in retail gold buying, on top of central bank purchases. This combined demand could set the stage for real fireworks in the gold market.
The institutional bias within the Fed is that the Fed believes, probably rightly, that they're the only branch of the U.S. government that's concerned about inflation. That Congress believes that they get paid to spend. The administration wants to spend because we're in an election year. And so from the Fed's point of view, the institution that stands between the U.S. dollar and oblivion is in fact the Fed. Now, from the administration's point of view, there's two different things they have to do, which are contradictory. The first is to tell Americans that they're enjoying a great economy and that all of the employment statistics and all that kind of stuff are great. At the same time, they would benefit, they know, from lower interest rates. So they have a sort of a schizophrenic approach to dealing with the Fed. And I really don't know how it's going to work out. I was amused at President Biden discussing the economic statistics 10 days ago, taking credit for employment and lower oil prices and all that kind of stuff. When it suits them, of course, they attack the grocery chains like Trudeau does for high prices. And then they turn around and say that grocery prices are moderating through their own efforts. You know, it's the typical election year BS. And I think that the Fed is being pushed backwards and forwards by all this politics. But as I say, I think the bias within the Fed, and I need to tell you that I don't know anybody at the top levels of the Fed, but I know some of the regional governors and I know some of the employees in the Fed. The bias of the institution is clearly to maintain closer to market interest rates rather than manipulating interest rates down. People go with their money to where it's treated well. For political expediency, for domestic political purposes, both Canada and England have lowered the interest rate they pay on savings, which causes more Canadian dollars and more British pounds to seek safe haven, or relatively safe haven, in the U.S. dollars. That's why Doug Casey has always said the U.S. dollar is the worst currency in the world, with the sole exception of all the others. Whether or not for purposes of political expediency the U.S. will be forced to do that is a different and, open question. I think a reason why your listeners need to continue to consider, having gold as part of their savings. Gold would seem to be the only currency on the planet that doesn't have a domestic political constituency in favor of devaluation. There are political pressures that cause countries like Canada, Great Britain, and the United States to deprive savers of a reasonable return on their investments. Gold has no similar constituency. That the gold price has moved without the participation of the traditional saver, the retail investor. Studying ETF data suggests that for the last 2 years, retail investors, at least in Western Europe and North America, have been sellers rather than buyers of gold. The buyer of gold has been foreign central banks. And I think that has as much to do with a weaponization of the US dollar. The use by our administration of the US dollar as a means of exerting foreign policy, both through confiscating $300 billion worth of Russian treasury holdings and also through the weaponization of the SWIFT banking system. Interestingly, too, Charlotte, away from your question, when people are concerned about the dichotomy between interest in gold and the gold shares, the fact that gold has moved and the gold shares haven't moved, I think that's explained by this phenomenon. The central banks have been buyers of gold, but they aren't buyers of gold shares. So it makes perfect sense that because the audience for gold, at least temporarily, has changed, that this dichotomy exists. Going back to the first part of your original question, in my experience, the gold price is tied to interest rates only in the sense of whether interest rates are negative or positive, which is to say, when investors are concerned about the maintenance of their purchasing power in conventional fiat instruments, then they become interested in gold. That hasn't happened yet. And I will note, as a consequence of my age, I was there, that it took 5 years for this to happen in the 1967-1972 time frame. In other words, while people understood that inflation was taking place, the perniciousness of it, the impact on their own personal lifestyle, wasn't apparent for 5 years. And my suspicion is that we're facing a delayed punch with regards to taxpayers and savers understanding the impact of inflation on their own purse. As they come to understand that, I think that you will get a layer of retail buying, the traditional retail buyer, on top of the central bank buyer. And if I'm right with regards to that, then you could see some real fireworks in the gold price. It was significant for two reasons. One, they were the biggest buyers of gold. If the biggest buyer goes away, it has an impact on price. But there was also a psychological impact. There are some gold investors like myself who buy it as an insurance policy, who buy it out of fear. I personally couldn't care less if gold goes from $2,275 to $2,500. I'm not a trader in gold. That's not why I own it. I invest in other asset classes for capital gains. I invest in gold for protection. But there's a whole different group of people out there who are more momentum-oriented. And for them, the fact that the hiatus in Chinese buying might last 3 months, as an example, and as a consequence, the gold price might not move for 3 months, that prevents them, in some senses, from accessing gold. I believe, as people come to understand, people in the United States and Canada come to understand that the CPI is a very inefficient mechanism for measuring the deterioration of the purchasing power of their savings and of their salaries, that people will begin buying irrespective of Chinese intention. But until that occurs, factors like Chinese buying and the lack of Chinese buying will impact the market, perhaps more so than the direct impact of Chinese buying or a lack of Chinese buying, if that makes sense. I think the psychological impact of it on the trading community and the speculative community was as great as the actual impact of the impasse in Chinese buying. I think it's a very important factor. It's very difficult to quantify. I've seen a lot of estimates, and I've seen a lot of people try to justify their estimates, and I suspect that most of them, like me, don't know. But what I do know is that there is a strong cultural predisposition to buying gold among ethnic Chinese. I've done business with ethnic Chinese for 20 years, at least. In China, not just in North America. And there's a strong interest in gold. It wasn't that long ago that Chinese were prohibited from owning physical gold in certain terms, with certain exceptions. What you see now is that the government of the People's Republic of China is actively encouraging savings in gold. And I think that there's a lot of appetite in the citizenry for increasing their gold holdings. Private savings are increasing rapidly in China, and the Chinese people in general have a predisposition to save as opposed to spend. And I think that there's a lot of concern in China. I can tell you this anecdotally from Chinese people that I correspond with about future economic stability in China. And so there is a nervousness among many Chinese about investing in traditional savings products. At the risk of being accused of being racist, the Chinese people that I know are very much gamblers and very much speculators. I have noticed in my time on Earth that precious metals bull markets are led by fear buyers. So gold is the predominant mover in the early part of a bull market. As the precious metals narrative is given credence by the increase in the gold price, then the speculators come in, the greed buyers come in. The speculative silver market, perhaps because of its lower unit cost, I don't know, creates a frenzied environment. And there, again, is a cultural predisposition in China around silver. It hits fertile ground. But on top of that, Chinese people are notoriously fond of speculating and gambling. And my suspicion is that A, we will have a silver bull market, and B, the extent of ethnic Chinese participation, both in the diaspora, but more particularly in the PRC, will be extraordinary this time around. Whether or not that participation comes down into the silver mining shares, at least among Chinese in the PRC, is a very different circumstance. Certainly, you have seen ethnic Chinese participation in silver equities in places like San Francisco and Vancouver for decades. Whether or not that extends to the PRC, and whether or not the infrastructure to distribute junior silver miners in junior silver mining equities in China develops is of course a different conversation.